Picture two companies. One builds tiny drones that fly into battle. The other builds the radars and sensors that watch over entire skies. Both are sitting right at the heart of the new defense and technology boom. Today, we put them side by side. Red Cat Holdings versus Hensoldt. Two very different bets on the future of defense. Let's dig in. In this video, we're looking at two companies from the defense sector, but they could not be more different. One is a small, fast-growing American drone maker. The other is a large, established German electronics giant. We'll cover what each company does, how the stock has performed, the positives, the risks, and then we'll compare them head to head. Let's get into it. Red Cat Holdings is an American company that makes small military drones. These drones are used for reconnaissance, surveillance, and increasingly for strike missions. Its flagship product is the Black Widow, a compact drone with AI capabilities that can operate even without a GPS signal. It also makes the Fang drone for precision operations and the Edge 130 for longer-range missions. Simply put, Red Cat builds smart, small drones for modern warfare. The company was founded back in 1984, but for decades it was a completely different business. The big shift came after 2020, when management decided to go all in on military drones. In 2021, they acquired Teal Drones, a company that already had ties with the US military. Then, in 2024, everything changed. Red Cat was chosen as the sole provider for the US Army's short-range reconnaissance program. That means Black Widow drones will be carried by American soldiers. They also acquired FlightWave Aerospace and partnered with Palantir to embed advanced software into their drones. Red Cat is a small company, what we call a small cap, with enormous growth potential. The US Army has essentially stamped its approval on their main product. For many investors, that's a golden ticket. Add to that the global surge in demand for military drones, and you can see why this stock gets a lot of attention. In 2025, Red Cat pulled off something impressive. Revenues hit $40 million. A jump of nearly 460% compared to the year before. To put that in perspective, the year prior, revenues were under $8 million. The growth is explosive. However, the company is still losing money. Net losses in 2025 were around $72 million. This is not yet a profitable business, and that's important to keep in mind. For years, this stock sat below $1. The all-time low was just 35 cents back in March 2020. The last 5 years, the stock started a gradual recovery. The Teal Drones acquisition in 2021 sparked some interest, but the stock remained relatively quiet for the next few years. 2024 to 2025 was the year of the explosion. As soon as the victory in the short-range reconnaissance program was announced, the stock skyrocketed. It reached a new all-time high of $18.78 in March 2026. From March 2025 to March 2026, an increase of about 190%. Today, the stock is trading around $9 to $11 after a correction. Within a year, we saw a total increase of about 60%. Analysts believe that even at these levels, the stock has the potential to reach $20 to $25. Let's now look at the pros of the company. First, it has an exclusive US Army contract. That's a major endorsement. Second, revenue growth is exceptional. Third, The Palantir partnership gives it access to top-tier AI technology. Fourth, it's expanding internationally into the Middle East, Asia-Pacific, and Latin America. Fifth, it's an American company in an era where the U.S. government strongly prefers American-made drones. Let's now look at the cons of the company. The company is not profitable, and it's unclear when that will change. It depends heavily on government contracts. If priorities shift, that's a problem. It's a very small company, so the stock can be extremely volatile. And there's always the risk of new share issuances to raise cash, which dilutes existing shareholders. Analysts covering Redcat rate it a strong buy, with an average price target around $20, nearly double the current price. In early 2026, Redcat continues to expand with new acquisitions and new product lines. A leveraged ETF based solely on RCAT was launched, a sign of growing retail investor interest. And Q1 2026 revenue came in at 849% growth year-over-year. That number is hard to ignore. Let's now look at the second company, which is Hensoldt. Hensoldt is a German defense electronics company. It doesn't make drones or tanks. It makes the eyes and ears of modern militaries. Radar systems, optronics, electronic warfare, and identification technology. If a fighter jet needs to detect an enemy at night, it likely uses Hensoldt technology. If a naval ship has a radar system, there's a good chance Hensoldt had something to do with it. Simply put, Hensoldt builds the sensor and detection systems that make military hardware work. Hensoldt's roots go back centuries, tracing through the legendary Carl Zeiss Optics Company, one of the most respected names in precision optics globally. In 2017, it was spun off from Airbus as an independent company. After a period under private equity ownership, it went public on the Frankfurt Stock Exchange in 2020. In 2021, the German government took a 25% stake, a strong signal of strategic importance. In 2024, Hensoldt acquired ESG GmbH, a defense IT company, expanding its capabilities into software-defined defense. Hensoldt is right in the middle of Europe's massive rearmament push. Germany, NATO, Eastern European nations. Everyone is increasing defense budgets. And Hensoldt is one of the key suppliers. That means stable, predictable, long-term revenue for years to come. In 2024, Hensoldt posted revenues of €2.24 billion, up 21% year-over-year. In 2025, revenues grew further to €2.46 billion, another 10% increase. Net profit in 2025 was €89 million, slightly lower than 2024 due to heavy investment in production expansion. But here's the really exciting number. The order backlog, meaning orders received but not yet delivered, reached €8.83 billion. That means Hensoldt has years of guaranteed work ahead of it. The stock had an IPO in Frankfurt in 2020 at around €12. In the first few years, it moved without major fluctuations. The big jump came in 2022, after the invasion of Ukraine. Suddenly, the whole of Europe was talking about defense. The stock reached €30. Then, in 2024 and 2025, as European defense budgets continued to grow, Hensoldt broke one record after another. 2025 was a standout year. The stock pushed past €80 mid-year and hit a 52-week high of around €117 in October 2025. Since then, the stock corrected and today trades around 75 to 77 euros. The one-year return is approximately 22%. The 52-week range sits between 61 and 117 euros. Its pros. First, it has decades of proven history and deep expertise. Second, the European rearmament wave is a once-in-a-generation opportunity. Third, the €8.83 billion backlog means secured revenues for years ahead. Fourth, it pays a dividend, €0.40 per share, appealing to income investors. Fifth, the German government is a shareholder, which adds stability. Sixth, management has set a target of €5 billion in revenue by 2030. Let's see now the cons. The explosion in new orders hasn't translated immediately into revenues. There's a delay because of supply chain constraints and the need to ramp up production. Profits were lower in 2025 due to heavy investment spending. Competition from other European defense giants is intense, and for investors outside Europe, access to this stock requires trading on Frankfurt or via OTC markets. Deutsche Bank has a price target around 113 euros. JP Morgan recently reaffirmed a hold rating. Around 17 analysts cover the stock, a sign of serious institutional interest. The long-term view from most analysts remains positive. In 2025 and 2026, Hensoldt announced investments of around €1 billion to expand production capacity. It signed contracts with India, specifically with Hindustan Aeronautics, and NATO's commitment to raise defense spending targets to 3.5% of GDP by 2035 creates a long runway of demand for companies exactly like Hensoldt. Let's put both companies side by side. Size. Red Cat is tiny compared to Hensoldt. $40 million in revenue versus €2.46 billion. The gap is massive. Growth. Red Cat wins on growth rate. 460% revenue increase versus Hensoldt's 10% in 2025. But that's partly because Red Cat is starting from a much smaller base. High growth from a tiny starting point is very different from steady growth at scale. Profitability. Hensoldt makes money and pays a dividend. Red Cat loses money and pays no dividend. Clear advantage to Hensoldt here. Risk level. Red Cat is significantly riskier. Volatile stock, unprofitable, small company, dependent on continued government contracts. Hensoldt is more stable, more predictable, and backed by a government shareholder. Geographic exposure. Red Cat focuses primarily on the US military market. Hensoldt serves Europe primarily but is expanding globally. What they actually do. Both are in defense, but they operate in completely different areas. Red Cat is drones. Hensoldt is sensors, radar, and electronics. They're different tools for different parts of modern warfare. Red Cat Holdings may suit someone looking for high growth, willing to take on significant risk, and believing strongly in the future of military drones. It's a high-risk, high-reward kind of stock, the kind where things can go very well or not go as planned. Hensoldt may suit someone who wants stability, long-term growth, and exposure to Europe's defense build-up. It won't give you the explosive upside of Red Cat in a short time, but it has revenues, profits, a dividend, and a backlog that speaks for itself. As always, before making any investment decision, do your own research and consider speaking to a financial professional. Nothing in this video is financial advice. And that's our comparison. Red Cat versus Hensoldt. Two companies, Two very different approaches, one sector that's reshaping the world. If you found this useful, hit like, subscribe, and I'll see you in the next one.